All right, folks, things are escalating at a really high speed. All right, we already knew so far that the DOJ is onto something big here, according to the latest facility storage being burnt. We know that there are 30 to 60 investment firms solely mostly doing short selling that are actively being investigated. On top of that, we know that we have new rules coming this month that are potentially going to swift and change totally how securities lending work and also short selling work. But I'm going to bring you in this video something in addition to all of that, actually pointing out to the fact that everybody all the way to the White House, it's now willing to put an end to this whole shenanigans happening with short selling, and it has a big impact in stocks like AMC. So let's get into this. I already shared with you that some of the new regulations were a conjunction, all right, a joint venture per se within many agencies, not only the SEC or not only the DOJ. Now, this is the website of the U.S. Department of Treasury, the DOT, for all of those loving acronyms. I know we love acronyms here in the U.S. But the truth of the matter is there is a council, all right, the Financial Stability Oversight Council, which is really oversight by who? The president. This is the DOT, all right? So every agency actually is being overseen by ultimately the White House. Now, here's the thing. When you look at what they agreed in a meeting last Friday 4th, the council received updates from member agency staff on progress over the past year regarding these three type of NBIF working group and the council and rulemaking activity. Now, we have three main items that they talked on. And one of the most item here, which is really juicy for us in AMC, it's about hedge funds activity. Look, in 2021, the council reestablished its hedge fund working group. A primary objective of this interagency staff level working group was to update the council assessments on potential risk to the U.S. financial stability from hedge funds, their activities, meaning what they do on a daily basis, and their interconnections with other market participants, allies, all right, what the DOJ calls allies, brokerage firms like Robinhood or TD Ameritrade or Fidelity. Those are what we call the allies. Now, let's continue to read onto this because it gets very interesting towards the end. Recent market events have provided opportunities to assess how financial strain at hedge funds, particularly those with significant leverage, could create risk to financial stability, and how reduction of financial intermediation by hedge funds during periods of market stress could exacerbate market impairment. Hedge funds were among the largest sellers of treasuries by category in March 2020. When you look at the Archegos, the working group also found that the failure of the Archegos Capital Management, a family office employing leverage strategies also used by hedge funds, transmitted material stress to large interconnected financial institutions. Basically, what they're trying to say here in this first paragraph is, well, according to what happened in 2021 and 2020, when you have a bunch of these companies named hedge funds. The hedge funds are these companies that take huge amount of risk, huge amount of bets in the stock market, usually using short selling strategies. And they do so by being over leveraged, meaning they go really deep into debt, leveraging a lot of money that they don't necessarily have sitting there in cash or sitting in their books. All right. But we've seen what can happen with the case of Archegos Capital. And based on that and other examples, now this joint venture, the hedge fund working group named and kind of put together by this council with the DOT, where we have the SEC, we have the CFTC, we have a bunch of other agencies, is now trying to make sure how this doesn't happen again. All right. So moving forward, the council supports the hedge fund working group's effort to establish an interagency risk monitoring system to identify potential emerging financial stability risk posed by hedge funds. The council also supports the working group's efforts to consider options to mitigate the risk it has identified. Now that we know how big of a chaos this can create into the market, they are now trying to brainstorm and see what solution can be brought together in order to fix this thing. All right. So this working group based on hedge fund stability risk now The council member agencies are taking steps to address these gaps. We have the SEC and the CFTC are developing amendments to the Form PF, the primary regulatory data source on the private fund industry. We talked about it a couple of weeks ago when the SEC voted on actually getting more frequent instead of disclosing activities. What stocks am I long? What stocks am I short selling? Am I, deep into naked shorts? Everything into transparency instead of disclosing that quarterly or yearly is now going to be done every single day by end of trading session. The SEC has proposed a new requirement that certain advisors to hedge funds report timely information about events that indicate significant distress at the fund. In addition, the council supports the hedge fund working group recommendation at the Office of Financial Research to obtain data on uncleared bilateral repurchase agreement markets. Now, if you tie this to something else that Gary Gensler just said literally last Friday, here's what we said. Let's listen.
Let me turn, Gary, if I could, to a second item on the agenda in no particular order here, and that is payment for order flow, something that you've come out against. Last August, you said you were considering actually banning it altogether. Where does that regulation stand at this point? Do you still think that's possible to ban it altogether, or is it more likely we'll have full disclosure?
Well, again, what we're trying to do within our remit is help investors get a better deal on one side and companies raising money on the other side, a better deal, and drive greater transparency and efficiency in the middle of the market. So in the equity markets right now, if you place a market order, a retail market order, 95% do not go to the lit exchanges, do not go to NASDAQ or New York Stock Exchange, they go to wholesalers.
99.5%. This is pretty much every single one of those retail trader of orders that people like you and I who are investing in the market are actually sending out. But it's not only it's not only limited to you and I, it's also the pension funds, the 401ks, all right, the IRAs, because those are also labeled retail trader. Retail order. So it's a big deal.
And they don't have order by order competition. And part of that is because of what you just said, payment for order flow, which is, yes, it's banned in the UK, in Canada, and Australia. The European Union, through something called ESMA, is looking at that right now. And so I think it's natural that we look to say, how do we drive greater competition and efficiency in this market and use the tools that Congress have given us?
But are you keeping open the possibility, the option at least, of banning it altogether? And if so, when will you make a decision whether you'll do that or not?
Well, it would be a decision for the 5-member commission. We would put it out to notice and comment so the public gets to weigh in. We benefit from the public's view, from the investor side, the issuer side. So basically, a lot of our market right now is dark. It's not in the lit markets, David. It's dark and going to wholesalers and how we get more transparency and competition in the market. So each feature is on the table, whether it's something called the minimum increment or tick size, or the national best bid, best offer, and how the order routing works. And yes, that includes not just payment for order flow, but possibly what's called exchange rebates. So it all fits together, and we haven't served up a recommendation to the commission yet. And the commission, if they supported it, would put it out to public comment.
Do you have an estimate or a guess on when you might serve it up to the commission?
David, I learned long ago not to sort of do that. I have occasionally, and it's about trying to get the economics and the law and the policy right, get it in front of a commission. If so, get it out to the public. So I understand the question, but I'll beg off for it.
All right, folks, this is interesting because literally what Mr. Gary Gensler, is saying is in all other places, in all other markets, in modern countries, we don't have payment for order flow. How can we expect to have confidence into a market where everything pretty much goes throughout the dark? It means it's controlled by a little tiny group of people that are able to do whatever they want, and we don't want that. Here's the thing, folks. If you don't pay attention to this, just look at it. 2020 and 2021 were record years. 2020 was a record year on the downtrend, and 2021 was a record year on the uptrend. Now in 2022, things are going to be a lot more different, especially when it comes to inflation. So everybody is trying to make sure what happened in 2020 doesn't happen again, especially causing something that will be close to 2008. So it means cleaning up the market. Now, cleaning up the market, it's either you remove entirely payment for order flow by banning it completely, kind of aligning yourself with what the rest of the world is doing on on stock exchanges, all right? Or you use what he called disclosure, full disclosure, meaning every single day before the market closes or right after the market closes, you send us every single thing on your activity so that we can analyze everything and make sure you are not doing what you shouldn't be doing, all right? Because by doing so, they maintain kind of a sort of confidence. Here's why it's important. It's important because, first of all, you keep retail investor. Retail investor participates for 30%. So if you and I, plus all the other pension funds, insurance firm and everything, not investing into the market, it's like third of everything, all the dollars circulating into the stock market being pulled away. They don't want that because it's chaotic. Second, you are actually preventing foreign money from being flown into your market. You are preventing the Canadians, the Europeans, the Asians, which are also full of billionaires willing to make the money work for them and diversifying their net worth. So it's a matter of legacy and it's a matter of survival. Now, how does it all translate with AMC stock and everything? Well, if the hedge funds cannot use payment for order flow anymore, now we can really see the buying pressure being true. We can see the real buying pressure translating into the stock price, because I've shared with you many times. When you look at the buy or to sell order ratio, you have way more people buying than selling, but the share price is not reflecting that. Why? Because of payment for order flow and dark pools. So if you remove that, boom, everything goes through the exchange, and that's how everybody's buying. It's now going to push the price where it's supposed to be. Is it 1,000? Is it 2,000? Nobody knows, but it's way higher than what we see now. And third, if you include transparency and hedge funds, kind of preventing them from being as risky as it is, it means short selling will also kind of be lowered. If securities lending, which allows you to borrow shares in order to short sell them to begin with, it's not as easy as it is right now, because the hedge funds will be monitored, starting at the kind of coming from the White House with the DOT and the council. Man, it's like every single thing preventing AMC from going to the moon will then go. So based on this, it's just a matter of time. Let me know what you think in the comment section.